$500 into a leveraged semiconductor fund at 15 bucks a share. Sold it a month later. That same fund now trades around $277. And the investor? 25 years old, asking Reddit to help them cope. This one hits different. Hey Profiteer, Eric here. Welcome back to Real Money Stories. Today we're looking at a post from the investing subreddit about the worst investing mistake you've ever made. And honestly, the comments on this one are a gold mine. So this comes from the investing subreddit. The original poster is 25, kicking themselves over a trade they bailed on way too early. Let me read it to you in their own words. Back in early 2023, an old coworker told me to invest in SoCell. So I put $500 in for what was $15 a share at the time, then sold it like a month later to get the money back. Now it's trading at $277 a share. Could have been pretty rich for my current age of 25 if I'd continually put money into the stock. What's your worst mistake trying to cope, lol? 403 upvotes, 477 comments. Clearly this struck a nerve. Okay, first thing I want to say reading this, I feel you. That gut punch of looking at a ticker you used to own and watching it climb without you. Almost every investor has felt that sting. That feeling is real and it's brutal. So before we get into the money side of this, just know you're not alone. Not even close. But here's where I want to pump the brakes a little, because I've been writing about money for over a decade, and the pattern I keep seeing with posts like this is something called hindsight bias. It's the mental trick where past events feel like they were obvious and predictable, but only because you already know the outcome. And that bias is doing a lot of heavy lifting in this post. So let's walk through what's actually going on here. I want to cover three things: the math reality, the risk reality, and what I'd actually do at 25 with this lesson in my pocket. First up, the math reality, or what I call the paper millionaire trap. The original poster bought at $15 a share. $500 gets you about 33 shares. At $277 a share today, that's roughly $9,000. Real money, but pretty rich. At 25, not quite. $9,000 is a nice chunk, but it's not life-changing wealth. And the original poster said, if I'd continually put money into the stock, which assumes they would have kept buying on the way up, through every dip, through every red day, without flinching. That's a massive assumption. Most people don't do that. Most people can't do that. The same impulse that made them sell after 1 month would have kicked in during every pullback along the way. Now here's the part most people miss. The risk reality. This is where it stops being textbook. SoCell is a 3 times leveraged semiconductor ETF. I won't recommend buying or selling it, but I need you to understand what 3 times leveraged means. It tries to return 3 times the daily performance of a semiconductor index. Daily. Not annually. Not over a month each single day. That means if the underlying index drops 10%, this fund drops roughly 30%. In a single session, these products have something called volatility decay, which is the finance term for how the daily rebalancing math slowly eats your returns over time, especially in choppy markets. There have been stretches where the semiconductor sector went up over a year, but the leveraged version lost money because of all the zigzagging in between. So that the original poster isn't comparing apples to apples. They're looking at a lottery ticket that happened to pay off and thinking they made a mistake by not holding it. But holding a 3 times leverage product for years isn't investing. It's a very specific bet that most professional fund managers wouldn't make with their own money. Just a friendly reminder that this episode is intended for entertainment and education purposes only and should not be considered financial or legal advice. Now let's get to the good part. What I'd actually do at 25 with $500 and a lesson learned. I call this the boring wealth framework, and it's boring on purpose. Step 1, start with a broad index fund. Something that tracks the S&P 500. 500 companies instead of one leveraged bet on one sector. You still get exposure to semiconductors because those companies are in the index. But you also get healthcare, energy, finance, consumer goods. Diversification isn't exciting, but it's the reason people actually build wealth over decades instead of just talking about the trade they missed. Step 2, automate it. The real mistake the original poster made wasn't selling, it was not having a system. If you're 25 and you set up an automatic $50 a month into a broad index fund inside a Roth IRA, something boring happens. By 65, assuming historical average returns, that $50 a month turns into roughly $170,000. Bump it to $100 a month. You're looking at around $340,000. And here's the kicker. In a Roth IRA, you pay zero federal tax on that growth when you pull it out, zero. That's the real pretty rich play, and it doesn't require a hot tip from a coworker. Step 3. If your employer offers a 401k match, take every penny of it before you invest anywhere else. 100% return on day one. No leveraged ETF on the planet can promise that. The original poster is 25. That's not a tragedy. That's an advantage. Time is the one thing in investing you can never buy back, and they have 40 years of it. It always starts with the first dollar. And look, I want to be clear. I'm not here to make fun of the original poster or say they were dumb. They weren't. They put $500 into the market at 24 years old. That already puts them ahead of a lot of people. The instinct was right. The vehicle was risky and the timeline was short, but the habit of investing. That's the valuable thing. Keep that habit. Just point it at something with better odds. If you want to talk through what makes sense for your specific situation, I'd always suggest sitting down with a fee-only fiduciary advisor. A XY Planning Network is a great place to find one who works with younger investors. Here's the bigger picture. The specific question was about $500 and a leveraged semiconductor fund. But the principle that FOMO is not an investment strategy applies whether you missed out on $500 or $500,000. Every investor has the one that got away. The ones who build real wealth are the ones who stop chasing the last trade and start building a system for the next 40 years. Personal finance should be fun, but it should also be boring enough that you can sleep at night. If you found this helpful, share it with someone dealing with the same thing. Until next time, stay profitable.